it's a very competitive world out there these days for private equity firms, but also for lenders as the world opens up. We're talking with Randy Schwimmer, who's the co-head of senior lending at Churchill Asset Management and also the author of The Lead Left. Randy, thanks so much for joining us. Always love to hear your perspective. Let's talk about some of the challenges facing deal makers today. I mean, I can't help asking, what are you and your clients, what's keeping you up at night these days?
Well, thanks, MK. It's great to be with you as always. I can say we're sleeping a lot better now than we were sleeping a year ago. Things are pretty dicey, back in March, April of last year, as you know, and things have dramatically improved since. One of the ironies, of course, is that now that people are feeling a little bit better and feeling like vaccinations are unfolding and the economy seems to be on the mend, that there's a sense that the coast is clear and hey, let's put a lot of risk assets on, and feeling in some cases as if there's nothing to worry about anymore, which of course is just not the case. We're still pretty much in a pandemic. I mean, obviously, I think some of the trends are quite positive, but if you look around the rest of the world, clearly not all trends are positive. And so I think that one of the concerns that we have is people forget too quickly the kinds of things that were going on last year and really actually through the bulk of last year. Things started to get better in the third and fourth quarter, particularly in terms of deal flow. We have seen in the first quarter, pretty good restoration of pipelines and coming into the second quarter as well. And I think that's going to continue for the rest of the year. But the competition for assets has really turned to be pretty intense, given that sense that people feel like the economy's on the mend and businesses that did well last year are going to continue to do well. And so I think that combination of a feeling of a little more optimism and also, frankly, an urgency to put money to work is creating some very competitive dynamics amongst direct lenders and I think in general in private credit. And you've seen it certainly on the liquid side of the equation with the broadly syndicated loan market, where we've seen an amazing amount of volume through the fifth month of the year, as most of the spreads and prices have gone up, spreads have come down over the last number of months, and there's a lot of cash going into the asset class. So generally good, but still, I think the concern about how competitive things get is paramount in our minds.
Let's talk a little bit about deal structures and terms and pricing. How did the pandemic affect them, in the previous months, but also what's going on right now in terms of those deal terms and pricing?
Yeah, it's a good question. We get asked that all the time. So there's been two types of impact, right? The negative impact in terms of what's going on is, particularly in terms of competition, is that it's as if nothing ever happened right now. It's as if COVID never happened. And in some ways, it's as if COVID isn't happening in the current environment, which it is. We're credit investors, right? So, we buy assets, we hold them till maturity or until they get paid off or the companies get sold. Churchill is a direct lender in the middle market borrowers that are all backed by top quality private equity companies. And so we don't trade, we don't hold to distribute. We hold the assets, we're buy and hold lenders. And so the result of that is that we own the risk, and which means that something that we buy into day one is going to be with us. And so we need to have a high degree of comfort that transaction is going to make it through no matter what happens. We were very conservative going into COVID, not because we knew COVID was coming, but we knew that 2018, 2019, that the recession, some sort of recession was going to happen at some point. The recovery was aged to the point after, I think, over 10 years, right? When you think about where we were after the Great Recession, and how long that recovery was ongoing. You remember all the comments about what inning are we in? And, everyone thought, well, we're pretty close to the ninth inning by now, and we knew something was going to happen soon. So we were prepared for COVID. We had invested in pretty much the same defensive industries in the beginning of 2020 as we had over the past decade. So when COVID hit, the vast majority of our portfolio was fine. There were some businesses that were impacted. But in general, we made it through. We had no defaults related to COVID at all. No losses, no defaults through that period. So I think that kind of discipline worked for us. It worked for other lenders as well. But we feel now that it's just as important to maintain that kind of discipline, even though some, I think, lenders think that the coast is clear. There are still risks out there, particularly with businesses we call the have-nots, which were heavily impacted by COVID. And I think, so to the extent that we're worried about things, it's not being alert to the kind of credit risks that could bite you at any time, which was obviously what happened last year. Now, there has been some positive impact and to COVID. One of them was the fact that with businesses that were the haves, these are the companies that had more defensive postures, less consumer-backed facing businesses. For those businesses, we found, and you all have written about this extensively in your great publication, the purchase price multiples for on the M&A side for properties that were being bought and sold by private equity firms were at or higher than pre-COVID levels. And what that did for direct lenders was it provided more capital below us than had been the case. And so right now, I think if you look at the middle market overall, the amount of equity to capital in new buyouts is well over 50%. So while debt to EBITDA, the way we measure leverage, has been going up in general since a year ago, the debt to equity to capital and has also been going up, and the leverage as a percent of total capital has been pretty steady. And in fact, it's somewhere, I think, 45% debt to capital, which is pretty attractive relative to historic performance. So I think that is one positive. Now, you could argue some of the sponsors are overpaying, but they're really doing that for only the best businesses, where they figure if this company did well in 2020, it's going to do well in any environment.
Do you see a lot of price inflation? I mean, I've certainly heard, private equity folks talking about high valuations and with some concern.
Yes, one of friends of ours who is a partner at a very top private equity firm, and I said to him, do you think that people are overpaying? And he said, absolutely. We know in certain situations where we came in second that we were overpaying and we lost the deal. So we know that the party that ended up winning the deal was overpaying. The challenge, I think, for all of us in private equity or private credit is that we have capital to put to work from our LPs. They're expecting us to continue to put money to work in tough times as well as in good times. And so it seems like the worst is over, which I think that's probably true. People are very interested in saying, hey, I may have missed the boat in 5 months of last year, so from, say, April to September, but I'm going to make up for it this time around. And so I think there's that sense of urgency to put money to work. Also, think about where interest rates are. Even though the long end at for example, 10-year treasuries has gone up significantly since the first of the year, the short end has been pretty anchored near zero. LIBOR is pretty close to zero at this point. And so I think investors are saying, I'm still not getting the kind of yield that I'd like to get for my assets. And so trying to put money to work in what seems to be a quasi post-COVID environment is very attractive to them, particularly now that we see where a lot of these businesses are headed performance-wise.
So that sounds like 2021 is going to be an amazing year for M&A. Yeah,
I mean, I think if you think about the economic outlook for the for what's going on in businesses overall, the pent-up consumerism that's clearly waiting for people who are, getting out of their houses and trying to spend money. I know anecdotally, just trying to get summer vacation plans in order is a lot more challenging than I thought it would be several months ago. And if that kind of dynamics have played out across the nation, I think we're in for a busy second half of the year, no question.
Well, good. I'm looking forward to it. I was intrigued to see that you've been working with Lincoln International on some benchmarks about managers' performance. Share with us a little bit about that. That sounds really interesting.
It is. Well, they're actually doing all the work, but Lincoln is a very well-respected middle market investment bank. They lead the industry, one of the market leaders in terms of valuations. And they had previewed with me the senior debt loan index that they were working on. And the Lead Left is a terrific platform, I think, to promote something like that. We've been talking on the Lead Left for years about the challenges investors have to benchmark middle market credit because there's no transparency to the asset class. By definition, private credit, like private equity, is private. The values of these businesses are private. Therefore, the prices on loans is a private consideration. And so it's very hard for investors to do what they normally do and look at public benchmarks. So like the BAML high yield index or compare it to public equities and so forth. It's hard because there's no obvious one. Cliffwater, we talked about the Cliffwater index, which is really derived from BDC assets, and they do a great job there. The Lincoln International Index is derived from the 2,400 portfolio companies that they value, all of which are financed by direct lenders such as Churchill. And so taking that portfolio database of portfolio companies and converting it to an index is actually pretty exciting because that's 2,400 companies is a lot, and it's a very diverse database. It allows them to track not just returns, but also the elements that affect returns, which is a combination of interest rates and credit risk. And so when they reached out to me, I thought it would be a great idea to publicize what they're doing. So we're having a multi-part series, which started last week and is continuing for a couple of weeks, that talks a little bit about how they structure the index and the advantage to investors who are looking for some kind of benchmark that's out there by which they can compare manager performance. So that's why I think this is interesting.
Yeah, it sounds like a very useful tool and really filling a need in the marketplace.
Indeed.
Before we let you go, I'd love to hear you weigh in on a couple of issues that we'll be covering a lot this year and always do, but we've got two big projects coming up. One about diversity, equity, and inclusion, and the other one about environmental, social governance, ESG. So DEI and ESG are two big projects that we'll be working on at the end of the year. I'd love to hear your thoughts on how those issues play into anything going on in the lending market. How do lenders view those issues through your lens?
Well, those are two of the most important, what I'll call social issues of our time. And I know that TIAA, which is our ultimate holding company, and Nuveen, which is our direct parent company at Churchill, are in the forefront of both those issues. With diversity, it's on the minds and hearts of everybody in terms of what's important, and we've seen that roll out nationally. Both TIA and Nuveen have been in a leadership position. All you have to do is go on LinkedIn and see all the great work that they've done. At Churchill, we take both of those elements very, very seriously. Our investors know that, for example, with ESG, it's a priority and it's part of our actual policies in terms of investing. It's critical to us. It's critical to our investors. And I think we're at the early stages, as an industry in terms of understanding the impact here. But the fact that that we and so many of our colleagues in the lending industry have really begun to work closely with their investors and their clients to have a conversation about what does it mean to be focused on these issues. And I think this is something that is probably going to be growing in importance throughout the decade. And it's heartening for me as somebody who's been in the industry for 4 decades to see the direction that this is going. Because anybody who cares about the people, and how we behave as an industry, because it sets a tone, is going to realize that the two issues that you mentioned are core to people's beliefs and should be. So hard to see anything that's more important. And I really appreciate the question.
Good. Well, I'm glad to hear your thoughts on it. I personally think that we're at the beginning of kind of the accountability phase. The events of last summer with George Floyd's murder in particular put a lot of awareness and a lot of discussion on some of these issues. But I think now, and also the urgency of climate change. But now I think we need to see measurement, we need to see accountability, and hopefully mergers and acquisitions will be contributing to that process in the middle market with our 2 upcoming projects, which will become, this is the first year that we're doing them, but they will become annual issues. So Randy Schwimmer, so nice to see you, from Churchill Asset Management, and also author of The Lead Left, which is required reading in the industry. Thank you so much for joining us today.
Always my pleasure, MK. Thank you.